This episode is brought to you by Shopify. Upgrade your business with Shopify, home of the #1 checkout on the planet. Shop Pay boosts conversions up to 50%, meaning fewer carts going abandoned and more sales going cha-ching. So if you're into growing your business, get a commerce platform that's ready to sell wherever your customers are. Visit Shopify.com to upgrade your selling today.
I'm a big fan of multiple time frame analysis, meaning that in my trading, I like to look at different perspectives. That way I can have a better look and a better understanding of the market. Now, I'm not saying that every single strategy needs to use multiple time frame analysis. I do have strategies like advanced pattern formations, for example, where I only look at an individual time frame. But even with those situations, as I showed you guys in a few Trading Edge videos on YouTube, the knowledge of knowing what's happening on the higher time frame, meaning like the underlying trend, can allow you to be more, I guess, prosperous with your trading opportunities on those lower time frames. Anyway, what I want to share with you today on the Trading Coach podcast is a conversation that we had in one of our live trading rooms where a trader asked the question, how do I kind of balance the two? Meaning, what do I use each time frame for, and how do I deal with the confusion of using both? Well, here's my answer. But let's start off with the question, because Ahmed is dedicated to learning. So learning you shall do. I am trying to develop a trading style that I can consistently implement around other responsibilities. Easy answer. Ditch those other responsibilities and focus on trading. Boom. Problem solved. So I'm thinking of entering and exiting trades in the same day. Should I be using a 4-hour candle for seeing the bigger picture and a smaller time frame such as the 30 minutes for entries? I'm trying to understand how traders see the bigger picture and then drop down to an entry time frame. How do they then keep an eye on the trade? Back on a larger time frame or stay on the smaller time frame? Can you please illustrate this? Okay, sure. So if you want to be in and out of trades in a single day, you are looking to be a day trader, right? I had this conversation. I put out in a podcast the other day about picking time frames. About most day traders have I shouldn't say most, but I don't notice. No, I've never ran the numbers on this. So why am I saying most, Akil? I've never done a survey. But many day traders treat their day trading like an old school 9-to-5 job, right? Go back to like the old school like cartoons and stuff where, people are standing by the little, they had the little worksheet, the timing sheet, and like 8 o'clock or 9 o'clock, they punch in, and then they're standing by at 5 o'clock, they punch out. One of those type things where the day is over. So meaning that whatever they do during their day trading day, and obviously I'm not expecting you to trade 8 hours a day, but whatever that time frame is for you, whatever they do during that day, at the end of that day, like they exit. So their trade can be in loss and exit. Their trade can be in profit and exit. It's a clean slate. Each day is its individual kind of day. When time runs out, right? A little bit easier, a little bit harder in the Forex market because, 24-hour market, so there's not necessarily that market close. But that's how a lot of day traders think. I was a little bit of the opposite, and I never did the clock in, clock out thing simply because I did a lot of trend trading as a day trader, and there were because I swing traded and day traded at the same time, I always had this unique feel of bigger time frame predictions and lower time frame predictions, right? So I would have my swing trading predictions where I'd be like, ooh, euro dollar, I think we're going to go here. And then I would have my day trading predictions where it's like, smaller ones. Hey, we're going to do this, we're going to do that, we're going to do that. And every once in a while, I shouldn't say once in a while, but commonly, my day trading predictions would line up with my swing trading predictions. So it'd be like, hey, I'm looking for a longer term long on the euro dollar. And hey, I'm also in a longer term or a shorter term long on the euro dollar as a day trader. And I would tell myself, well, if my two predictions are lining up, why am I shortcutting my day trade, which I think has a couple hundred pips of potential to go higher? Why am I taking it out at 50 if my analysis says it can go 200 pips higher? So I would keep I would hold on to trades like that. Now it's very frustrating because you gotta manage them, and most of them never went to hit that higher potential because when you're day trading, your stops are so much closer than swing trading, so you'd be stopped out like overnight as the market like dips like 20 pips due to like some CPI news. But I just never had that mentality of closing out. I'm not saying it's bad. It makes perfect sense. If where I'm at now in my career, I would certainly do that just because we spoke about it yesterday, kind of the mental respite of not like running to your charts or looking on your phone every 5 minutes to see what things are doing. But those are different options that you can take. Now, going back to the question, as far as like, how do you keep an eye on the trade? Well, you keep an eye on the trade on your trading time frame, right? So, it's going to sound simple and stupid, but your trading time frame is what you do everything trading related from, right? So we get the question all the time about stops and targets and this and that and active trade management. All that should be done from your trading time frame. So your higher time frame is where you get your bird's eye view. You're surveying, you've climbed the highest of hills, you're surveying the land below, and you're making observations. And you're making observations with the freedom of not being able to trade, right? That is the biggest benefit of the higher time frames, right? People don't realize that weekend trading as well. I remember talking to, I think it was either Peter Brandt or Dr. Brett Steenbarger about this, I think it was Peter Brandt. The weekend is his favorite time to do analysis. Why do you think that is, guys? Why would the weekend be his favorite time to do the analysis? Ann says there's no chance to trade, right? And I want you to think about that for a little bit. It sounds stupid, but think about what goes through your mind in the live markets. You're staring at a chart. Candles are ticking. It's moving. There's a countdown to some high impact news event. You kind of feel pressured, do you not? Right? It's kind of like rushing to the airport and like you forgot something and now you might be late and you're running through the terminals. You kind of feel a little bit of pressure. Where it's like, okay, this thing is moving. What if I missed something? What if I analyzed it wrong? Oh my gosh, why is it red? I thought it was going to go green, right? So you're not as likely to do good analysis because you have this external pressure on you. The weekend relieves all that pressure, right? The weekend, even if you wanted to, you couldn't trade, right? Even if you wanted to, you couldn't trade. So one, the markets aren't moving. Everything as you see it is going to stay exactly that way. Two, you can't place a trade. It's very similar to like back testing, where it's like you have all the time in the world to do proper analysis. And because your mind doesn't have to focus on all these other things, it's 100% focused on the analysis only, which makes you sharper. So I look at the higher time frames as being very similar because if you're following your rules, big if, right? I'm looking at you, person who feels guilty, right? Should have put tape over your webcam. Yeah, I can see your face. The higher time frame, if you're following your rules, you know that you can't take a trade off of it. So you only have one job, do analysis. Now, there's a little bit of temptation like, ooh, I wonder what's happening on the lower time frames. Am I missing something? But in general, your only job is to do analysis. So you can lock in 100% on the analysis. And then once you've gone through, again, your identify and predict components of your IPDE, now you go down to your lower time frame, right? That's where you decide and execute. So your decide and execute is everything that's left in your trading. You're deciding what you need to get involved in the trade. You are executing the trade if said thing happens. You are actively managing the trade. You are rolling stops, doing this, doing that, right? All of that is from your trading time frame. Is there any need to go back to your higher time frame? Once you jump off that cliff, is there any need to climb back up? And it's an actual question. I'm curious if you guys think there's any need once we've done the deed. I can't think of any. The only scenario that I may think of is like if you have a candle, let's say you have a daily candle that is like a daily candle that is, or not daily, but a higher time frame candle. Yeah, the only thing I can see or say about going back to your higher time frame is that, let's say you were dealing with a candle that was at a decision point, right? And you had a candle that had, like, let's say broken and closed, or no, which was trading below that decision point. So it was trading below a previous level of resistance, but it was a candle that was still in progress, right? So you have it didn't technically break and close below. The only way I can see going back to a higher time frame was maybe at the end of that session, going back up to see like, hey, did this candle violate? Did this candle hold? And that may or may not impact your trading. I'm trying to think of a way it would. The fact that you got into the trade anyway shows that you didn't care, but maybe it affects like a secondary target. Maybe you were going short, and if you didn't get that confirmation, you were only taking maybe a single target at a retest of the lows. But if you did get that confirmation, you were adding that extended target at a 127 extension or something lower. Does that make sense, guys? So that's just making brain work, right? That's the only way I can see going back to a higher time frame, kind of maybe changing what's in your trading. But aside from that, yeah, everything else should be done from that trading time frame, or a lower time frame, right? If you're going to actively trade manage, some people have their trading time frame and then they drop to a lower time frame for, rolling stops or trailing stops and stuff like that. The summary is your higher time frame is used for identifying, predicting, right? Your trading time frame, whatever time frame you drop down to, is used for deciding and executing. There's no need to go, aside from that one scenario that I just told you, there's no need to go back up to your higher time frame. I don't think it gives you any relevant information that would affect your trade. So the way that you continue to manage or watch, or I'm trying to think what the question was, to keep an eye on that trade, is by staying on the time frame in which you executed the trade. Yep. But it's the same IPDE process we always follow. IP, higher. DE, lower. Hope you enjoyed the show. Rate and review the podcast before you go. Also, if you want to learn with us or you want to hop in the live trading room, please do. It's a great community of traders and some awesome coaches, if I do say so myself. Just head over to www.tier1trading.com. Start with that 14-day risk-free trial membership. I say start there because you want to make sure that we are the right fit before you commit. All types of rhymes today, all right? www.tier1trading.com, 14-day risk-free trial membership. No sneaky auto bill or anything like that. 14 days, then boop, you're kicked out. See you there.